Hello and welcome to the Increased Giving Through the Effective Use of the Tax Code presentation. My name is John Madison. I'm with Dayspring Financial Ministry. In order to not distract myself and you as I'm going through the PowerPoint presentation, I'm going to go ahead and minimize the video portion so we can concentrate on the PowerPoint slides. I am a CPA from Virginia. I've been a CPA for over 30 years. I started personal financial counseling as a ministry through my church in 2012, really had an interest in personal finance, and just it was a way that I felt like I could serve my fellow church members. And so I began to teach classes and work one-on-one with folks in 2012. And over the intervening, I guess, 8 years or so, it's expanded from where it first started. I'm going to give you a little more on my background at the end of the presentation. I want to make sure we have plenty of time to go through the tax strategies. But I do want to share a little bit of information about Dayspring so that you'd understand the approach that I take through the ministry. I actually volunteer my time to Dayspring, whatever it brings in the form of book sales or travel assistance or website revenues, counseling revenues, whatever it may be. It stays within Dayspring to cover my travel costs, the publicity for what I'm trying to do, and the operating expenses for the company and the website. I don't draw any of it out for my personal use as a salary or anything like that. I don't sell any insurance or investment products to anyone. That's not what I feel called to do. I don't get any sort of referral fees from any recommendation that I may make to someone that I'm working with. And I don't manage money for anyone else or their investments. This is strictly a teaching ministry that's focused on stewardship education. That's it. So I don't want you to think like this is a sales pitch for any particular product or anything like that. This is really focused on teaching. Well, why do we need to explore tithing strategies? Obviously, you have a little bit of interest because you're watching the presentation, which I greatly appreciate. So just very briefly, why do we need to even look at these strategies? Well, tithing is a scriptural mandate. So believers are to be tithing from their increase each year. Scripture also calls for us to pay taxes to whom taxes are due. So that's another principle by which we should be conducting ourselves. So the question is there a way to legally save more in taxes from our contributions? In other words, can we set up the way that we're contributing to legally pay less in tax that then frees up those dollars to be used in kingdom purposes in other ways? But again, still comply with all the tax laws. Well, obviously there is a way to do it. That's the whole genesis of this particular presentation. There are 4 strategies that we're going to talk about specifically in this presentation. Now, taxes are, if you've ever spent any time working on your taxes, you know they're really complicated in a lot of situations. So for time purposes within this presentation, we're only going to present the strategies in general terms. It's going to be the 30,000 foot view. We're not going to get down into all the ifs and buts. And, normally there are some exceptions or rules that need to be followed on these strategies. We just don't have time to get into them because they're so specific to a particular taxpayer. So please consult with a tax professional before you try any of these at home. So the 2 questions that I'd like to cover for the presentation today are, what are those 4 tax efficient strategies that I mentioned? And then how can the church teach these strategies? It takes both of these to really be effective. If this could be an effective ministry tool for the congregation, they need to know what the strategies are, but then we need to figure out a way to actually teach these strategies to the congregants. So let's dive in first to the actual strategies. And again, we're just going to touch on these from a very broad stroke. Well, the first strategy is to donate appreciated investments. Now, here's what the rule is. Let me read through it, and then we're going to do an example because it's going to sound really complicated, but it's really pretty straightforward. If you donate an appreciated security, so that's a stock, a mutual fund, something like that, that you've owned for more than a year, if you donate that to a charity, the amount that you're able to deduct is the fair market value of the security that you're contributing, not what you originally paid for it. Okay, so let's dive into what that means. Let's look at an example. In this particular example, we've got Noah who purchased 100 shares of Ark Building Company in 2015 for $20 a share. So he paid $2,000 for his shares. Fast forward 5 years, those shares are now trading at $80 a share. So it's been a great investment for Noah. So those shares are now worth $8,000. Now, Noah would like to donate $8,000 to his church. Okay. Now, we're going to just assume for purposes of this illustration that he's in the 30% income tax bracket and 20% capital gains bracket. Okay, that would obviously depend on what state Noah is living in. We've got the federal tax laws, but then many states also tax, and they're all different. So we're just going to make this assumption for this particular illustration. So how does this strategy work, or what does it look like? All right, this is kind of a busy schedule, but it's really not that complicated. Let me kind of walk you through it. The middle column here represents what happens if Noah decides to sell those shares, pay whatever tax is owed, and then donate the remaining money to his church. So he sells shares for $8,000. We've established that's what the market value was. He paid $2,000 for those shares 5 years ago. So his gain, which is just obviously long-term, but that long of a holding period, is $6,000. We're assuming he's in the 20% long-term capital gains tax bracket. So he'd pay $1,200 in tax on that gain. Well, take the $8,000, he's got to pay the tax, that's $1,200. So he's got $6,800 in cash left after paying his taxes. He donates that to the church. We've assumed he's in the 30% income tax bracket, so therefore his tax savings is 30% of that number, or $2,040. On the other hand, let's look at the rightmost column. And instead of selling the shares and donating the net proceeds after his tax cost, we're going to make the assumption that he's just going to donate those shares directly to his church. Well, because he does so, the top part, the first several lines, no longer apply. He didn't sell the shares, so there is no long-term capital gains tax that needs to be paid. And because he donated the shares, remember on the previous screen, the amount that he gets to deduct is the fair market value of the shares, not what he paid for them. So in this case, those ARK shares are worth $8,000. So that's the amount that he gets to write off on his taxes that year. So his tax savings at 30% is $2,400 versus the $2,040. So what does all that translate into with this strategy? Well, his tax savings go up by $360 by donating the securities instead of selling them. And the charity or the church gets $8,000 donated to them instead of $6,800 donated to them. Now, Noah's Church, of course, is not in the business of holding shares of ARK or any other investments for that matter. So they'll immediately sell those shares and use the cash for their ministry, just as if Noah had written a check for $8,000. It's not a complicated procedure for the church to sell those shares and get those proceeds. Well, since the church is a nonprofit, they won't pay those capital gains taxes that we saw Noah having to pay if he was the one that sold the shares. Now, it is important to note from the church's perspective, the church has to have a brokerage account in order to receive those shares. Because remember, Noah's donating the shares while they're still actually shares. So the church has to be able to receive those in a brokerage account, be able to sell those shares, and then get the cash proceeds from the sale into their church checking account. So they would have to have a brokerage account to be able to handle that transaction. Now, strategy 2 is somewhat related to that, but actually makes it maybe a little bit easier and adds some extra potential benefits. That's the second strategy is to establish a donor-advised fund. Now, a donor-advised fund is itself a 501c3 organization. It is a charity. And because it is, donations that are made to the donor advised fund are tax deductible for the donor when the contribution is made. Now, what's nice about this is you can actually use strategy 1 and strategy 2 together by donating appreciated securities, which is what we talked about in strategy 1, into a donor advised fund, which is strategy 2. So let's dig a little deeper into what this strategy 2 is. Now, the donations that are being made are irrevocable. Whoever donates to the donor advised fund cannot get that money back, but they do retain the right to recommend donations from the donor advised fund to another charity, which may include their church. My wife and I have used this strategy since 2013, and it's been a wonderful strategy for us to use to save on our taxes. Now, why would someone want to go through the process of basically running a contribution through a donor advised fund before ultimately the money ends up at your church anyway? So why go through the hassle of having a donor advised fund? Well, there's a number of reasons, more than I'm going to list out today, but I've tried to bring in the top several reasons that someone may want to use a donor advised fund. Well, the first thing is that it simplifies donating appreciated securities, especially if you're doing it to multiple organizations. And I think back to Noah and strategy number 1. He had those shares that were worth $8,000 and he wanted to donate it to his church. Well, suppose instead those $8,000 worth of shares, he wanted to donate, let's say $2,000 to 4 different charities. Well, each one of those charities, if we're using strategy 1, would have to set up a brokerage account. Noah would have to go to the custodian of his brokerage account and ask them to divide those shares up into 4 different lots, send 1 lot to each one of these different charities. Each of those charities would have to receive their lot, sell them, and get the proceeds. It can certainly be done, but as you can tell, there's a lot of steps. Well, with the donor advised fund, as we'll see, all of the contribution. So in this, if Noah was doing this, he could send all of those shares to the donor advised fund. They're set up to receive contributions like this. This is what they do. So they can very easily receive those shares, sell them within the donor advised fund. So there's no tax consequences of that to Noah. And now they have it in cash. Then they can send 4 $2,000 checks to the 4 charities that Noah had in mind. So it really simplifies that process in general, but really simplifies it if there's multiple organizations. And a lot of Christians, certainly, in addition to their church, have other charities and ministries that they like to contribute to. So it certainly makes it easier to do that. Another nice benefit is the donor receives an immediate tax benefit from the contribution, even if it takes them several years to ultimately dish out, if you will, the money that went into the donor advised fund to the ultimate charity. So they don't have to wait until those funds go to the ultimate charity. They get an immediate tax deduction right now, even before they've actually sent the money to those ministries that they want to support. And then lastly, and I think this is going to become a very big issue or opportunity with the new tax law that went into effect in 2018. It's what I call itemized expense bunching. With the increased standard deduction, fewer and fewer people are going to be itemizing. And so the donor advised fund may be a strategy that someone can use to continue to itemize in some years, take the standard deduction in other years, and yield a net increase in the amount that they can deduct. And this is exactly what my wife and I have been doing over the last couple of years. Once the new tax law came into effect, we'll itemize 1 year with big contributions to our donor advised fund being a part of those itemized deductions. And then the other year, the next year, we'll take the standard deduction as we're continuing to make our charitable contributions and our tithe contributions to our church from the donor advised fund in year 2. Now, let me give you an example of this, because I know that's a lot of information. So let me give you an example, and I think this will make it a lot clearer. We've got Abraham and Sarah. They are married and they file a joint return. Now we're going to assume for them that their itemized deductions are as follows. They've got state and local taxes, which are limited to $10,000. So we don't know what the number is, but it's at least $10,000, and they can't deduct any more than that. So that's the number we're going to use. They've got $8,000 in mortgage interest, and they make charitable contributions of $5,000 per year. So their itemized deductions are $23,000. Now for 2019, the standard deduction for a married couple was $24,400. Therefore, Abraham and Sarah would certainly take the standard deduction, which is larger than their itemized deductions. So for a 2-year period of time, and that's really what we need to look at for an example of a donor-advised fund, they would have $48,800 in standard deductions for that 2-year period of time. Now, suppose instead they used a donor-advised fund. Now, what would that look like? How would their tax situation change because they use a donor-advised fund? They want to do everything the same, but is there an opportunity here for them to continue to give $5,000 a year to their church in year 1 and year 2, but potentially save on their taxes? Well, there is. Here we have another schedule. The center column is year 1. So in year 1, they'll still have their $10,000 in state and local taxes. They're still going to have their $8,000 in mortgage interest. But instead of contributing $5,000 to the charity, they're going to take 2 years worth of their contributions. And again, this could be an appreciated security in their brokerage account. It doesn't have to be cash, but they're going to take 2 years worth of contributions, or $10,000 in this example, and they're going to put it in the donor advised fund in year 1. Therefore, their total itemized deductions for year 1 are $28,000. Well, that's larger than the standard deduction we saw just a moment ago of $24,400. So that in year 1, they would take the itemized deductions of $28,000. Now in year 2, in the right-hand column, they still have their state and local taxes, they still have their mortgage interest, but they didn't make a contribution to the donor advised fund in year 2. They had no new contributions to charity in year 2. Now they were still tithing to church because they had the donor advised fund send $5,000 to their church during year 2. So the church doesn't notice anything different, but there were no new contributions to the donor advised fund in year 2. So their itemized deductions for that year are only $18,000. Well, again, the standard deduction is higher, so they would take the $24,400 in year 2. Now you take those 2 years together. With the donor advised fund, they were able to deduct $52,400, which is the $28,000 from year 1 plus the $24,400 in year 2. We saw on the previous screen that without the donor advised fund, they were only able to deduct $48,800 total for the 2 years. So everything happened identically as far as what the church got and the amount of contributions they made over the 2 years and all their other deductions, but they were able to actually utilize a larger total amount of deductions using the donor advised fund. So we see that they had those higher deductions. The charity or their church still received $5,000 each year that was distributed from the donor advised fund. And what's important to note here is the church or any of the charities that they may donate to from the donor advised fund would not need that brokerage account. They're going to get a check from the donor advised fund for the amount that Abraham and Sarah wanted to donate to them. So it's much easier. The church is definitely set up to receive checks coming in, whereas they may not be received or set up to receive shares of an investment. Strategy number 3, qualified charitable distributions. Now I need you to be patient with me as I work my way through this one, because I got to give you a little bit of background information if you're not already familiar with it for this to make sense. But this is another home run strategy, in my opinion, for folks that are subject to required minimum distributions. Well, let's talk about required minimum distributions, because it's their existence that creates the need for, or the ability to use, a QCD, qualified charitable distribution. Well, you may not realize it, but Uncle Sam is actually your partner in your pre-tax retirement account. So I'm talking about the 401k at your old job, or your IRA, or your 457 when you were working. Uh, he is your partner. Now, he is a silent partner until you reach 72 years of age, and then he wants to start receiving some money from you. Now, that used to be 70 and a half, but the new tax law that just went into effect in 2020 increased that age for starting required minimum distributions to 72. If you were if you'd already started RMDs because you were 70 and a half before the end of 2019, you're still on the old rules. But if you had not yet reached 70 and a half by 12/31/2019, it's now 72. So once you turn that age, he wants to start receiving some money. Well, he does that by requiring you to take, or forcing you to take, the required minimum distribution, which is based on your age and the size of your retirement accounts. The older you are, the bigger the percentage, and obviously the larger your retirement accounts, the bigger the dollars that he's going to want you to take out through the RMD. Now, just as an example, uh, if you turn 72 this year and you have a $500,000 retirement account, maybe that's your 401k from when you were working, your RMD would be about $18,250. Again, don't quote me on that number. It kind of puts it in the ballpark. Well, that $18,250 is taxable income taxed at your ordinary marginal tax rate, reported on your federal return, and it may be taxed by your state as well. Different states, again, have different rules on that. But Uncle Sam will get his cut from your retirement account when you claim that RMD as income. So that hits your return, you claim it as income, you pay tax. That's how Uncle Sam gets his portion of your retirement account. Now, if you're charitably inclined, which obviously you are listening to this presentation, if you did not use a QCD, let's say you're subject to the RMDs, you have to start taking these amounts out of your retirement accounts, but you're not using a qualified charitable distribution. Well, what does that look like? Well, you would take your RMD from your retirement account as instructed, as ordered by the government, and that creates taxable income for you. That's going to be on your tax return. Now, you could, if you were charitably inclined and you wanted to give that money to a church or any sort of charity, you could write a check to the charity of your choice, which would be tax deductible if you itemize. And those three words are really important. That's a key to this thing. If you itemize. With a new tax law that was passed in 2017, went into effect in 2018, roughly doubled the amount of the standard deduction. We saw those large standard deductions in the earlier strategy that we talked about. Well, because of that, the percentage of taxpayers who itemize is expected to drop from 33% to 10% of taxpayers. So 90% of taxpayers will not be itemizing. Well, if you don't itemize, you don't get the charitable deduction. So you still get to claim the RMD as income, but you can't deduct the contribution. Not a positive tax situation for you. Well, let's instead assume that you use a QCD. Well, the RMD is satisfied by sending the money directly from your retirement account, your 401k, your IRA, whatever it may be, to the charity. Because the money went straight to the charity and didn't come to you, there's no income for you that you have to pay tax on. Now, you also don't get the charitable contribution, but as we just talked about, 90% of taxpayers won't be itemizing anyway. So for the most part, there won't be any negative consequence by not getting to take the charitable contribution. Well, let's look at an example. As with so many of these things, it's easier to see the actual numbers. We've got Adam and Eve in this example, and they are both over 70 and a half, so they're both subject, or I'm sorry, they're both eligible for a qualified charitable distribution. For some reason, QCD age is still 70 and a half, even though the RMD age went to 72. Don't ask me why, that's just what happened. So they are over 70 and a half, so they can do a qualified charitable distribution. Well, let's talk about the center column for a moment. Here's some assumptions that we made for this couple in their 70s. They're still doing a little bit of part-time work, so they made $12,000. They've got some pension income of $18,000. In between the two of them, they have some Social Security income. You'll see the comment on the left-hand side that the total amount was $24,000. But as many of you know who collect Social Security, only a portion of that would be taxable. And so based on their income, the portion of their $24,000 in Social Security that would be taxable is $5,000. I ran the numbers on that, and that's the number that would be taxable. And then we're assuming in this example that their retirement accounts are of the size that they would have to have a required minimum distribution, the RMD, of $10,000. So for this particular year, with no QCD being used, their total income would be $45,000. We're going to just assume that they use the standard deduction. Let's keep it simple. They use the standard deduction, which for a married couple of their age would be $27,000. Their taxable income, therefore, is $18,000. They're in the 10% bracket at that level, and so the tax due is $1,800. Really straightforward. Well, let's assume instead that they wanted to donate that $10,000 to a charity, and so they used a QCD. So instead of collecting the $10,000 and then writing a check to a charity and deducting, and giving it, they may or may not be able to deduct it because of the large standard deduction. They decided to use a QCD and just let it go straight to the charity from their, let's say it's their IRA. So let's see what happens with the QCD. Well, their part-time work is obviously the same. That's still taxable, and their pension is the same. But notice that Social Security now is completely tax-free. And the reason for that is the next line down. Because they did the QCD, their RMD has gone away. They satisfied that by using the QCD, donating it directly to charity. Well, that lowered their income. And by doing that, by lowering their income, it reduced it enough that now none of their Social Security is taxable. So they get an added benefit by removing the RMD from their taxable income. Now that's down to $30,000 of total income. They get the same standard deduction. That doesn't change. $27,000, so they have $3,000 in taxable income, still in the 10% bracket, so there's only $300 in tax that's due. So they saved $1,500 by using the qualified charitable distribution. All of their numbers were the same. All of the facts and figures other than the QCD were the same, but by utilizing this strategy, they were able to save in taxes. Well, the fourth strategy that I'd like to talk about is charitable contributions upon death. So we went from taxes now to death and taxes. Well, if you intend, as I think a lot of Christians do, or a lot of charitably inclined people do, to donate a portion of your estate to charity when you die, make sure that you designate the donation from a pre-tax account such as an IRA or a 401k in order to get the best tax benefit for your heirs, really. I believe that your stewardship responsibility carries through your death and the disposition of your estate. And so this is a way to help your beneficiaries by properly designating any contributions that you want to make from the appropriate account. Assets that are held in these pre-tax accounts are taxable income if the beneficiary receives the funds from the account, or when they do. They're going to be forced. The law gets a little complicated here. So in most instances, they'll have to pretty quickly start taking that money out of those accounts and pay tax on it. But if a charity receives that exact same asset out of that pre-tax account, there's no taxes that are owed because, like we talked about earlier, the charity is a nonprofit. So they can get the money out of your IRA tax-free that, like your beneficiary, could not. Now, another nice thing about this strategy is it can be adjusted very easily and with no costs. Beneficiary forms with your IRA or 401k custodian specify who gets what in the event of your death. And these can be changed at no cost and without the need to adjust your will. You don't have to get your attorney involved. If you want to increase or decrease the amount that's going to charity, simply complete a new beneficiary form and it's taken care of. Now, some other assets that you would not want to, let me say it the other way, that have tax preferences for your beneficiaries that you shouldn't make charitable contributions out of, unless these are the only assets that you have, of course, would be life insurance. Those proceeds are tax-free to the beneficiary. So don't make a charity a partial beneficiary of a life insurance policy if you have pre-tax accounts that they could inherit instead. Roth accounts, so Roth IRAs, Roth 401ks, retain their tax-free status for the beneficiary. So don't donate those either if you have pre-tax assets that exist. If you don't have pre-tax accounts that exist and you want to donate to charity, then feel free to do so from any of these accounts or your life insurance proceeds. But if you have pre-tax accounts, use those to donate to charity. So how can a church teach these strategies? Now, I'll be the first to admit I'm not a pastor, but I can see how this could be a challenge for churches out there. Churches are not financial planning firms, so they may feel like they don't have sufficient knowledge to teach this information to their congregants. Uh, and churches would certainly or should certainly be concerned about who's speaking to their members and what their motivations may be. Are they coming in to speak because they want to sell a product to the church members and somehow manage their assets? That's a legitimate concern for a church. And let's be honest, financial stewardship lessons from church leaders may be interpreted by the congregants as a way for asking for more money. Well, I founded Dayspring Financial Ministry in 2019 to help with those concerns. To give a bit more background in our final few minutes here, a bit more background on my situation and how what led me to create Dayspring. I was blessed to retire from my full-time work as a CPA when I was 49 years ago. And God really gifted me in two ways. He gifted me in a lot of different ways, but specifically as far as Dayspring is related, he blessed my wife and I financially, which then created the time freedom for me to be able to speak to groups about biblical financial stewardship. And he also gave me an interest and a knowledge of personal finance and experience with teaching adult Sunday school classes for many years. And I'm reminded of the verse. I put it on this slide, First Peter 4:10, that each of you should use whatever gifts you have received to serve others as faithful stewards of God's grace in its various forms. And that verse really made an impression on me, that I should be using these gifts that God has blessed me with to serve others. He didn't bring me to the point of being able to retire when I was 49 so that I could sit on the front porch and watch the world pass me by. Why did he bring me here? What did he want me to do with this opportunity and this time freedom? Well, and so I really, after a lot of prayer and a lot of discussion and planning, decided to start and really felt led to start Dayspring Financial in 2019 to teach biblical financial stewardship. Now, what does that look like? How does Dayspring do that? Well, there's several ways. I was blessed with this time to put my thoughts down on what biblical financial stewardship looked like into a book. I didn't set out to write a book. I really started out with the idea of the workshops that I'll talk about in a second, and the book came about when I started trying to put together a handout for the workshops. It ended up being enough material, and I felt it could help those that I never get a chance to speak before to get this information. And so I put it all in a book format, and it's now published. It's available, at Amazon and all these various places. And the purpose of it was to really provide very practical, modern financial advice and strategies that's consistent with the principles of Scripture. And it's only a couple hundred pages long. It's not technical. I'm not using technical language in it because I want it to be something that was a low cost, easy access tool for anyone who wanted to pick it up and read it. The ebook version's $4, so I really tried to keep the cost of it really low so that it could be available to as many people as possible. And then I also have felt led to put together live in-person workshops to any church that's willing to host an event. It'll talk about financial stewardship, as well as these tax-efficient tithing strategies that I've just barely touched on in this presentation. We'll go much more in depth. There's examples, there's times for Q&A. It's about a 3-hour presentation with the Q&A times. Because I'm blessed to be able to retire early, I don't charge a fee for my time to give these presentations. If there are travel costs involved, if you're not in the Central Virginia area and there's travel costs involved, I'd certainly like to talk to you about still coming to your church. And if you could help with the travel costs, that's great. It's not even required. Certainly, let's have a conversation. Don't let any of that keep you from starting a conversation with me to see if me coming to your church is a way that I can help you and your congregants. And then finally, for any of those who are interested in confidential one-on-one personal financial counseling, I do offer that as well. It's done over the internet, so it can be. I've had clients from the East Coast to the West Coast. I've even had them had a client in Europe as well. So location really doesn't matter, but this was a way to give people one-on-one details about their specific situation. And like I mentioned earlier, any funds that come into Dayspring from any of these sources, whether it's selling the book or counseling or travel assistance, whatever it may be, stays within Dayspring to help me keep the cost, or to cover the cost of doing these ministry efforts. So if you have any questions about the tithing strategies that I've talked about today, or about the workshops or the book or anything else that you have that I can help you with, here's all my contact information. My phone number, please feel free to give me a call, an email. You can go to the website. There's more resources and information. There's free resources that you can download as well to learn more about what it is that I do. So I greatly appreciate your time and your attention as we worked our way through what can be a pretty dry subject of tithing strategies. So I hope you found it helpful. And again, please feel free to reach out to me if I can be of assistance. Thank you, and God bless.